I've never invested in stocks, have always had a fascination with them. Just getting an education with perhaps services like yours.
That's why we started, actually. My daughter, her very early stages of COVID, and she's in her mid-20s, and she was telling me that just every guy that she knows, every millennial she knows, is having a go at trading the stock market. And some are doing well, and some aren't doing well at all. And she said, we should provide some sort of a service, Dad, where you're providing some of your expertise. And so that was really the inspiration for this, is to really provide what we call directional clarity for the active investor. So we really stress patience, wait for the market, wait for the buy signal to unfold before you act. A tiger will sit and wait, and they'll watch their prey for hours before acting for that exact right moment. And if it doesn't develop, you don't act. And when it does develop, you must act. It's about as simple as that.
I'm Garrett Wong, and this is the Investing to Win podcast. How do you define success, and what does winning look like for you? Cary, welcome to my podcast.
Thanks, Garrett. It's a pleasure being here.
Oh, a pleasure's all mine, and I appreciate your podcast agent reaching out to get you on the show. In pre-show, we were talking about, and you were asking, why have somebody who's an expert in the markets and stocks and things like that on what started out to be a real estate investing podcast? And as I told you, investing, I believe in diversification, and it's not only about real estate, and the financial podcasts have done really, really well on here. Having said that, you were saying a whole bunch of different terms that that were completely over my head. So I know my listeners and I are going to have our pencils ready. But why don't we back up and give the listeners a little bit of your background?
Well, I've been a commodities analyst since Artac Advisory was formed in 1996, so it's going on 30 years. And prior to that, I had spent about 10 years at the Chicago Board of Trade and Chicago Mercantile Exchange in Chicago, of course. And I got a job as a runner when I was 22 years old. I was just sort of fascinated with the whole sector. I'd spent 4 years in the Air Force. When I got out, it was within a matter of months that I met someone who was an active, experienced trader at the Chicago Board of Options Exchange. So I learned about puts and calls, option strategy. There was, the circumstances were always such that my ambition initially was to just trade, to actually be a trader. But I didn't have any money, and I was making about $400 a week as a runner on the trading floor. But I just kept finding people who were more experienced and successful. And I worked for a very successful options trader. I went through the crash of 1987 with this person as their right-hand man, so to speak. I was always providing them, where they were position-wise in the markets. When you're a pit trader, you're sometimes trading hundreds of times in an 8-hour period. So keeping track of the score, so to speak, is paramount. And so that was my job. I did that for a couple of years. The stock market crash of 87 really sort of decimated the options markets in Chicago at that time. And I really had to sort of find, where it is that I was going to survive in Chicago. And I went across the street to the Chicago Board of Trade, where I interviewed with a futures company, a futures trading, commodity futures, a trading firm. Actually, they were trading the 30-year Treasury bond futures. It was basically a fellow and his brothers who had started this firm, the five of them from Chicago. They had a staff of about 20 people. And I worked my way through that company for a couple of years. One of the things that I was really found fascinated with what they did was technical analysis of the underlying market, which is something that I'd never done before. When I was across the street at the Board of Options Exchange, it was all studying spread relationships between, puts and calls and butterflies and back spreads and ratios and so forth and so on, which that's just too deep of a topic to get into right now. But in the futures markets, it was a simple element of just analyzing the underlying market with trend lines and channel formations. They had a team of online or researchers in their office. It was called the War Room. And I say online because they were across the street in an office analyzing this whole wall of screens, oscillators and moving averages on 5, 15, 30-minute bar charts. It was all very short-term trading. And they would call the results down to the trading floor. And as it turns out, I was oftentimes on the other line. Then I would hand signal the results of these 5 and 15 minute moving averages into the trading pit. It was a very unique operation, and the traders that I would to flash these signals to would actually be able to make use of this information. So you could get a buy signal on a 15-minute bar chart by because the market had done something with respect to these technical analysis methods that we were using, and they would make money based on the buy signals or the sell signals or whatever the case may be. So this sort of ignited a fascination for me in technical analysis. And there are hundreds of methods that one can employ. I thought one of the weaknesses, frankly, of this firm is that they did not look at the long term view of the market. It was all very in the moment, 5 minute, 15-minute bar charts, taking advantage of intraday swings. And I would notice and I did my own analysis after hours from home, and I'm reading lots of books, lots of material, pouring through all kinds of analysis methods. There are hundreds, really. And I would see, for instance, a channel formations that spanned 6 years, that the 30-year Treasury bonds were now rallying, maybe a descending channel where the market had been in a 6-year bear market. And now it's actually rallying up to this price point, which would be considered a sell opportunity or an area where the market may have trouble sustaining upward momentum and then is inclined to fall away from. So this firm that I was working with really wasn't paying attention to any of this stuff. And I thought they were missing really the big picture, and literally the big picture. It is the long-term trends that sort of rule the market. And so if you've got a buy signal, let's say, that is a 3 to 5 day or a 2 to 3 week buy signal, and if it exists in the confines of, say, I don't know, a 2 or 3 year bear market that's well defined, that buy signal is prone to fail, to not follow through to its objective. And so knowing what the underlying trend is really critical in any analysis, whether it's stocks or futures or commodities. And so within a couple of years, I began to work my way up the system, so to speak, within this firm, and I became a highly respected, office technician whose opinion was sought after. And in fact, on the trading floor itself at the Chicago Board of Trade, I was developing a reputation amongst many traders there for being someone who had a pretty solid opinion about the market. And so the traders were coming up to me all the time and asking my opinion, and this sort of started the whole idea of beginning Artac Advisory, which is just a service for providing market direction for traders. And that was in the mid 90s. And, with the advent of the internet and with Windows 95 and file attachments, it began to dawn on me that I didn't need to trade on the trading floor anymore. And it was around this time in the early 90s as well that the very first element of electronic trading began. And I thought that this is writing on the wall. And even some of the powers that be on the trading floor understood that the introduction of Globex, which is the after hours electronic trading system, was a precursor to what the market would become within about 10 years. So the trading floors don't really exist anymore, but they were quite an amazing experience. I mean, the 30-year Treasury bond trading pit was the largest in the world. It had 1,200 people yelling and screaming in this large trading pit. And then there were another several thousand surrounding that pit who were basically support personnel from clerks and runners and moving information around. So it was pandemonium. And I was quite fascinated with it. It no longer exists. I mean, there are some very reduced elements of that on the trading floor, but for the most part, all of the volume is moved into the electronic area. And that happened in the early 2000s. And, so I could see that that's kind of where the industry was going. And I realized that that would be an advantage to me as as an analyst, that there would be an increasing demand for the kind of work that I do. When you're a pit trader, it is really sort of a kind of a gut level experience. There's a certain set of qualities for being a successful pit trader that are very different than being an off-floor trader or investor. You can see what's going on in the trading pit. You can see who's buying and who's selling. You can see if there's more sellers coming into the market than buyers. You can then, if that's true, you can then play the short side or the sell side of the market. And so, there's a sort of athletic element, a sort of quick reflex element, a sort of disregarding any sort of concept, and just being in the moment. That's really the key of being a good pit trader. But being a good off floor trader is a whole different set of qualities. There's a certain cerebral quality, an intellectual quality. You might think on things for days, even as to whether or not you're going to pull the trigger on a particular investment. And so, one of the things that I've used, I just have kept it simple. My analysis, I think a picture is worth 1,000 words, as they say. I think it's an old famous Chinese proverb. And I use channel formations. A channel, a series of descending lows that are parallel with a sequence of descending highs. That is a pattern. And when that pattern, you can either play inside the pattern. So if the pattern has not yet disrupted, in other words, if that pattern still exists and the market is rallying up to the top of that channel, that is your profit taking opportunity. That is your selling opportunity. Selling could mean either exiting a long position that you previously owned, or it could be at that point in time, as we call in the industry, reversing and playing the short side. You could then short the stock outright. Maybe you reach for some out of the money puts that you could buy in anticipation of what I call bearish rotation. And inversely, if the market is testing that channel top and it closes above that channel top by a 1% margin, that's a level that we've used for years, now you have a buy signal. And so the opportunity is on the buy side. And that's really what I look for with my subscribership. So I'm kind of fast forwarding here a little bit, but I've been doing commodities for over 30 years. And about 4 or 5 years ago, my daughter was just graduating from school, right in smack dab in the middle of COVID. And, she had this idea: Dad, why don't you apply what you've been doing in the commodity sector in the stock market? We should build a website and we'll have an online e-commerce, stock market analysis. And so that was sort of the genesis of Wicked Stocks. Wicked Stocks is, it's wickedstocks.com. We provide a basic subscription package of 2 stock picks every week. We also do daily analysis in the SPY and the Triple Q. And if your listeners aren't aware of what the SPY and Triple Q are, the SPY is the ETF, or the tradable version of the S&P 500, and the Triple Q, the symbol QQQ, is the tradable stock entity that correlates 100% with the Nasdaq 100. So they are both great ways to trade the broader market, and they're the most popular stock entities in the world. Day traders to hedge funds use them constantly. And so we have a daily Triple Q, daily SPY analysis, 2 stock picks a week. We do Apple stock analysis. Anyway, and so, the basis of our methods are very simple. We look for channel structures. My son joined the company about a year after we started it, and he's a year younger than his sister. He graduated with a mathematics bachelor degree, and he loves the whole technical analysis element. So he gets out ahead of me, and he'll comb through dozens of commonly known stocks, typically mid to large cap stocks, that we look for these buy opportunities on the buy side. And we present them in very deliberate ways to our subscribership. So when the market closes above a key level, we'll give a buy recommendation. So,
Wow.
and yeah,
Sorry,
I know there's a lot there.
take a breath, Cary.
Sure.
Wow. No, I'm teasing because I feel I know you already, but I'm just looking at our timer here, 12 minutes and 42 seconds of absolute technical wizardry. When I asked you for how did you get started? No, let's back up a little bit. I mean, you clearly
Sure.
know your stuff. I mean, wow. I actually want to unpack a little bit about the old days. I mean, the only thing that myself, and I'm sure my listeners are a little bit more savvy than I am because I've just been kind of that one trick pony in real estate investment, is Wolf of Wall Street and, what's that other one? GameStop, the movie there, right? Which I'm
Right.
sure are romanticized versions. But let's back up. You said you were a runner. That was your first job. Describe what a runner is.
A runner is just, take this paperwork from the trading pit to the desk. The trader or broker will oftentimes be representing a firm, or the runner will It's a runner can graduate into being a clerk too. So I'm just going to kind of blend the two together because runners typically graduate to being a clerk pretty quickly. And this is in the old days; they don't really exist anymore. But a clerk would they work for a particular trader or a brokerage firm who are trading in the trading pit, and they're trading 100 lots at a time, buying and selling, and the paperwork is piling up, and they're handing it over to their clerk, who is now taking it and finding the clerk that represents the other side of the trade. To make sure that, okay, now we bought 100 from you at this price, right, check. So you're constantly confirming the validity of the trade. And if the other side doesn't recognize it, and that would happen a lot, because you're looking across a sea of mostly men. Were some women in the trading pit, but for the most part, there's 1,200 men in the trading pit, and you're looking across, and you think you've got their eye, and you're doing all the hand signals, but you didn't realize that he was looking two guys over at you, from you, and so that's called the out trade. So the out trade, if the trader needs to know whether they have an out trade immediately, because if they don't know it, they've calculated that they are now long the market. But if the other person doesn't recognize that they sold them 100, let's say, they need to cover that immediately, or they understand that they're not even in the trade. So there's this sort of a system of constantly validating the trades that you're in, and that's what the runner and clerks do. And they bring this paperwork to a desk that may be part of the very same firm that they work for. And this paperwork gets compiled and sent upstairs to the offices that are all then check. There's overnight checking to make sure. And then you come back in the next morning to make sure that you don't have any out trades, because once in a while an out trade would slip through, and you've spent the night not realizing that you own 100 of a particular commodity, and that commodity is down 5% overnight. So these things would happen, and that's the runners and clerks were a critical part of that model. That model no longer exists. It is purely electronic now, and these trades are checked within nanoseconds now. It used to take several minutes, sometimes a half an hour on a busy day, to back up those trades to check and confirm that they're good.
Sounds absolutely crazy. And it's not that long ago. I mean, mid 90s, it's not like we didn't have email, but like describe, I mean, a trading pit. I mean, I can picture what it is, but people outside of a trading pit in a particular exchange, could they not make trades? Or, I mean, how do you even get to be one of the revered people in the pit?
Sure, they could make trades from outside. They would typically, if you wanted to buy, this is a great example for segueing into, for instance, let's say that we're talking corn instead of a 30-year Treasury bond futures, we're talking corn futures or soybean futures. And if you're a 10,000-acre soybean farmer in southern Illinois, you're going to be oftentimes hedging the risk that is inherent in that. So if you're planting in May and there's all this risk, you don't know if the crop's going to be wiped out from flooding or from drought or from an early freeze. There's all this risk. And so oftentimes farmers themselves would sell short, or the futures markets themselves, in order to hedge the risk there is in owning and growing the soybeans. So I'm going back to the 1980s and 90s, where a farmer would call a broker in Cedar Rapids, Iowa. The broker would call Chicago and talk to their guy in Chicago, who would then relay that to the trading pit. And within a few minutes, they would have a confirmed fill on a particular a short or long trade. So if a farmer is growing crops, and let's say that they've got, I'm just going to say, let's go with corn futures, for instance. And if the corn futures are trading at $4 a bushel, let's say, and this farmer is basically growing their corn and all of their investments, from the seed to the fertilizer to the pesticide to all their equipment and everything, they're in it for about $3.75 a bushel. So they've got a 25 cent profit at this point in time. If in October, when they go to harvest, it is then still trading at $4. If it's trading at $4.50 or $5 a bushel, better yet. But what if it's trading at $3.25 a bushel? and they're in at 375. They're down significant sums of money, especially if they're in the thousands of acres. So farmers have been using futures markets for over 150 years. I mean, you have to go back to the 1840s when the Chicago Board of Trade came into being. And it didn't come into being to cater to speculators. It came into being to cater to the producers of the commodities themselves so that they could reduce the volatility that was oftentimes inherent in those commodities. Just to give you an example, there were wheat riots in the late 1830s and early 1840s, where all the wheat farmers around the Chicago area, by late summer, the price of wheat was through the roof because there was nothing left. And so the price of a loaf of bread was very high. In fact, you might not even be able to find any bread. And then so you've got wheat prices are substantially high, and then you come into harvest by early fall, and everybody's bringing their wheat to the market at the same time. And now the price of wheat collapses, and the wheat farmers were taking substantial losses for several years in a row to the point where they began to protest and dump their wheat literally into Lake Michigan. And so the powers that be, so to speak, sometimes they were speculators or they were business interests with deep pockets who would say, we've got to do something about this. So they created a futures contract. And that was really the earliest stages in the United States of the futures markets. It was really a deliberate attempt to reduce price volatility in a particular commodity. And in fact, in the late 80s, Alan Greenspan credited the advent of the 30-year Treasury bond futures in 1977 with being a key element in reducing the risk or the volatility that was happening at that time with the interest rate markets, the 30-year Treasury bonds, because large institutions, rather than having to sell their billions of dollars of 30-year Treasury bond certificates on the open market, were able to hedge that risk in the futures market. So it reduced the volatility that existed, and it actually could be credited with actually bringing down the inflationary rates, the interest rates that happened throughout the 80s from the late 70s high.
Wow. Just I can't even believe that that world existed when now, like you said, nanoseconds to be able to confirm a trade. Something that
Yes,
you've mentioned, Cary, the Chicago Board or it's Chicago Board of Trade. Okay.
yes.
New York Stock Exchange, you mentioned the NASDAQ, we've got here up in Canada, the TSE, Toronto Stock Exchange. Can you explain to the listeners how that relationship exists between, like, does the Chicago Board of Trade still exist today?
It does. It's actually called the Chicago Mercantile Group. The Mercantile Exchange, which was the S&P 500 and the livestock, live cattle, and some of the currencies, merged with the Chicago Board of Trade, which was they had their own 30-year Treasury bond futures. They had corn, wheat, and soybeans. So that all merged about a little over 20 years ago. And so it is still a futures commodities price, market. You've got the S&P 500 futures too, which is a big element in terms of hedge funds and fund managers being able to hedge the risk in owning 500 of the top corporate stocks in the United States. But I don't know if I'm answering your question or not. They are separate entities, and you can have a stock listed on the New York Stock Exchange and NASDAQ simultaneously. But for the most part, they find their home at one or the other. And so, because you can do arbitrage between the two as well. But anyway, go ahead.
Yeah, no, I think what I'm asking for myself and hopefully the benefit of my listeners is how many of these exchanges exist, let's just say in North America, when somebody takes their company public and for trading purposes.
Well, you've got New York Stock Exchange, you've got the NASDAQ, you've got Toronto. Chicago still has a stock exchange. Most of the stocks that I analyze and that I present to my subscribership as a buy recommendation are large cap. Sometimes we'll do mid cap. We kind of stay away from the small cap. Because the liquidity is not there, so you can get really kind of wild moves with an illiquid market. So we stick with the kind of your household names, and if it's a household name, a large cap stock, let's say, and I'd say 80% of our stock picks are in the large cap category, they're going to be on Nasdaq or the New York Stock Exchange. So in terms of my familiarity with all this, it's this sort of very fluid approach. You've got sort of electronic exchanges now that are emerging. I know Chicago has one, but for the most part, we're talking New York Stock Exchange and Nasdaq in terms of my analysis.
Okay. And then in terms of how futures, I mean, you've thrown out a lot of terms there. I'm somewhat familiar with them: day trading, long term type stuff. When you're advising and with Wicked Stocks, what are you advising on, all different types, or is it one particular sort of subsect of the market?
Well, we first off, we look for names that are popular. We're always looking at the Micron and Microsoft and AMD and Apple, and these are just big names that move the market, and they
Sure.
comprise a large portion of the Nasdaq 100. And so we like the fluidity, the volume of a lot of these stocks, and so that's kind of what we're looking at. They provide great buy opportunities when we get the buy signals that we see. Um, so I'm not quite sure if I'm answering your question again.
No, I think you are. No, like I said, a lot of my questions come from my naivety because I've never invested in stocks and have always had a fascination with them. I know my sister
Hmm.
has told me last week she's starting to get into them, but I mean, she won't touch the day trading, but it's just getting an education with
Sure.
perhaps services like yours. Maybe I'll segue
Absolutely.
that.
Yeah,
How,
that's great. That's why we started, actually, if I might interrupt. I mean,
yeah,
my daughter, who is now 28, one of the things she had mentioned when she was, convincing me to start Wicked Stocks with her. Now, her job was to build the website, and she was going to become an expert in all the sort of the back end, integration with, the email serving and so forth and so on, which is what she still does to this day. But she was mentioning this is the very early stages of COVID, and she's in her mid 20s, and she was telling me that just every guy that she knows, every millennial she knows, is having a go at trading the stock market. And some are doing well, and some aren't doing well at all. And she said, we should provide some sort of a service, Dad, where you're providing some of your expertise in how to enter trades and get out of trades, what stocks are good to trade, what are not. And so that was really the inspiration for this, is to really provide what we call directional clarity for the active investor. And we have certain rules not rules, but guidelines that we recommend. One is, we know that we have a lot of day traders who follow our daily SPY and our daily triple Q, and those are very actively day traded entities, the S&P 500 ETF and the Nasdaq 100 ETF. But we also offer 8 stock picks at least every month, twice a week. And these are many times household names as well. We had a buy signal in Caterpillar a few weeks ago. Microsoft, as it was slipping down to a channel bottom, we recommended buying that. The channel bottom is in the low 400s, and we're ultimately looking for the low 500s as an objective, as long as it holds that channel bottom. And so, we also recommend that people not devote more than 10% of their portfolio to any one of these stock picks. And if you use your portfolio or your trading account exclusively with the Wicked Stocks stock recommendations, it won't take long before you fill out with 10 individual stocks, each of which comprises about 10% of your trading portfolio. I also have a rule that I've used for years, which is I never risk more than 2% of my trading capital on any given trade or any given investment. And so the beauty with the 10% rule is that a stock, if you follow the 2% drawdown before you stop out of that trade, if you're only 10% invested, that stock needs to move about 20%, which is not very common, but it can happen. It needs to move against you by 20% before you're stopped out. So very often, if they are stopped out, it's at the very early stages. My belief is you're playing defense. We believe wholeheartedly in a conservative risk management. There are 3 elements to good trading. One is analysis, which I've provided for years, and I think I provide very good, solid market analysis. It's technical analysis. I read charts. But the other two are trading psychology and risk management. And it really is risk management that is the crux to successful trading. If you've got a good risk management strategy that is systematic and disciplined, um, and it keeps you in the winning trades and gets you out of the losing trades at an early stage, you're going to be on the winning side. It almost, I mean, it does matter that you're picking good stock picks, that you've got good buy recommendations. And I think we do that at Wicked Stocks. But you can have a pretty sloppy analysis that is just based on maybe it's just based on a 20-day moving average, and you buy the stock if it's above the 20-day moving average and you get out if it breaks below the 20-day moving average. That's a pretty simplistic approach. The problem with that is you're going to get what we call in the industry chopped up at times, where the market closes below it and closes back above it 2 days later and closes below it 3 days later. And it gets into this sort of sideways trade where you're taking these micro cuts on your longer term investment. So we try to eliminate that noise with the channel structures that we provide. The channels that we're looking at are 6 months plus in the making. So they are longer term. And while it's not 100%, there's 60 to 70% probability when a market closes above a well-defined 6 month or 1 year or 2 year channel structure that it's going to move in the predicted direction. And then it's just a matter of how do you get into the stock? How do you buy it? You have these little choices. Do you buy it market on close? On that very first week that it closes above that channel and you have a valid buy signal? Do you buy it at the market with the final 10 minutes of the closing bell on a Friday afternoon? Or do you wait for the following Monday or Tuesday to see if the stock falls back to your key support level where you get maybe a better price? Or then maybe that Monday it continues to move away to the upside. That buy signal is now working nicely. And now you're chasing that stock. So these are the little choices you have to make. And this is where your risk management and your trade execution decisions come into play. And having a systematic approach, we provide that with wickedstocks.com. We tell them, if we close above this point on Friday, that's your buy signal. So I'm getting kind of deep in the weeds on this, but these are the little nuances that are very important to trading. Without them, there's uncertainty. And whenever you have uncertainty, whether it's in trading or investing, even in real estate, sloppy things can happen. Mistakes can be made. And so we try to cover all of the bases, so to speak.
You're very clearly technical, and I appreciate that because I'm a technical person as well. One of the questions that I had researched to ask you is the difference between technical and fundamental analysis. And I know that you are on the technical side. What is the other side of the analysis, and what other people might use for fundamental?
Well, fundamental analysis, if you're looking at the stock market, for instance, one of the key components could be the price earnings ratio. That's a common one. Return on equity, debt to equity ratio. I mean, these elements, you can get kind of sophisticated with them. Because I was on the trading floor, I think largely because of the firms that I worked with early on, they were all technically based. That was the direction I went in. But even when I was in the Chicago Board of Trade, you had some traders who were looking at the 30-year Treasury bond futures trading. They were, what does Alan Greenspan say this morning? He was the head of the Federal Reserve at that time. And I'm going back to the late 80s, early 90s when I was on the trading floor. What is the key data that's coming out? The inflationary rate, the CPI, the PPI, producer price index. You have all these elements that affect interest rates. And so there were traders down there who followed that. I don't really think there's a right or a wrong to this. I have sort of followed the technical side because I love the simplicity of it. There's really, it's not always right. But the problem with fundamental analysis, from my perspective, is you get a lot of contradictory signals. You've got one signal that says it should be bought, and another that says not so fast, and another that says it should be sold. And which do you follow? So for me, I like the simplicity of technical analysis. I think the market is sort of tipping its hand and telling you outright if there's a very well-defined pattern that is now being disrupted, let's say a channel structure that's being violated and disrupted, it is likely to result in a trending market in the opposite direction. And so, and I've seen this unfold thousands of times. And, like I said, it's not always right. I'd say with these formations that I look at, there's a 60, sometimes 70% probability that they will work out. But what are you going to do in that 30 or 40% when it doesn't? Are you going to have a stop loss in the market at all times, which is what we recommend? I always recommend if you get into a trade, you have what I call a worst case stop loss. So that in the event all you know what hits the fan, you are stopped out of that trade. You never know what might happen in the world. There are black swan events that everything just, and if you don't have a stop in, you could lose your entire investment in a very short period of time. This is especially true in the futures markets, which are highly leveraged. And so you definitely need to work stops in the futures markets. And I always advise working stops in the stock market. It is that peace of mind element. If you've got a good risk management approach that keeps you on the winning side of the market and gets you out early on the losing side of the market, that results in a balanced trading psychology. The elements of fear and greed will not play havoc on your mindset if you've got a disciplined approach to risk management.
And at Wicked Stocks, you're not just giving predictions, you're also teaching and educating on these very sound and conservative techniques.
Yes, I think just the process, everything that we present is in video format and it's a screen share. So I am literally walking my clientele, our subscribers, through the chart formations that I'm looking at. I'm very transparent. I really think if they can see what's about to happen, that if we close above this, say, 3-week descending channel top in the SPY or the triple Q, and we're ready to close above it, that is your signal. You should not be short. You should be long now because we have a buy signal that I'm expecting to play out for the next few weeks. And I'll show you exactly where I think this market's going to go. It's going to go to the next significant longer term price resistance level that I will also show on the chart. So each video is 5 minutes, sometimes 10 minutes long, depending whether that's the SPY or the triple Q. I also do actually on YouTube. We have a free YouTube channel. Wicked Stocks is on YouTube where we offer daily NVIDIA and daily Tesla analysis that are identical to what we offer at wickedstocks.com in the SPY and the triple Q. And it's been a big driver of our growth for the last year and a half since we started offering this for free. And so people can see our work on YouTube as well for free. And it's the same exact format that we present on the buy side in terms of a subscription to wickedstocks.com.
No, I know in pre-show you were asking me if we had an opportunity to perhaps share some of these charts, because I think visually speaking, a picture is worth 1,000 words. You're talking about channel structures. I think I'm starting to get it now. I
Sure.
know that we're doing this on video on YouTube. For those listeners who are maybe in their car on Spotify and Apple Podcasts, I mean, I would encourage Cary right now to maybe throw up a couple of these on the screen. And if you're listening on the audio version, just head over to our YouTube channel to check it out when you have a chance. But could you enlighten us a little bit?
Sure. I've got about a half a dozen charts I can spend a little time on. Can you see this, Garrett?
I can. Yep.
Okay, great. So I'm going to start with the NASDAQ 100. And now, so just so you know, the triple Q, there's an ETF, a stock that looks identical to this chart that is tradable as a single stock entity. This is nothing more than a 5-year channel top that we tested, and you can see the lows go back to 2020 and 2022, and there's an intermediate high November of 21, and we just basically cast a channel off this high. And in July, we tested it for 3 weeks, and it held beautifully. I could show you, and I'm not today. There's a channel structure that held the downside in the August low. But over the last month and a half, 2 months, we've had a series of buy signals that suggests we are going to retest this channel top at 20,878. So that's an example of a classic channel that has held the buying side of the market in the NASDAQ 100 beautifully. If we were over the coming weeks to close above this channel top, that would be a significant, I think, paradigm shift for the NASDAQ 100. We're already in a 2-year bull market, as you can see, but if we close above 20,878 by the 1% margin, which is the green line, we enter another 1 to 2 year bull market that should become increasingly vertical up to 28,515. The S&P 500 has yet to test its 5-year channel top that is well above the market at 62.45. But I'm going to show you another chart, has been operating inside of a 1-year channel structure. So back in August, we told our subscribers at wickedstocks.com to buy this break at this channel bottom, and it held almost to the very tick. And we've been rallying ever since. And following that early August low, we've been telling them that you should now allow for upward bullish continuation to the 1 year channel top, that is a 6,028. And so this is a great example, once again, of a market behaving in a very well defined channel structure. I'm going to move on to Apple. Apple, back in June, on an AI announcement, pushed through this 1 year channel structure that is now at 196.74. And when we closed above this channel, we'd mentioned how 255.11 is considered a 3 to 5 month target. We're a solid 5 months into that, and we haven't reached the objective, but we think we're just another couple of months away from reaching 255. You can see also, just about a month and a half, 2 months after that buy signal, we fell right back to that channel structure. And we had told our Wicked Stock subscribers that this is a great stick your neck out buy opportunity for Apple, because we can bottom out in the mid 190s and then continue higher into the mid 250s within 3 to 5 months. And that's still what we're anticipating. And finally, well, not finally, I got two more to show you. NVIDIA. NVIDIA had a significant buy signal back in May of 23 when it closed above this very well-defined channel that spanned several years. You can see we had some degree of a rally. We fell right back to that channel, and then that was it. We just took off, and you can see where we're at now. I mean, I could go through a whole nother series of channel structures that NVIDIA has followed, but this is a great example of a buy side that we recommended our Wicked Stocks subscribers use and follow. And once again, when we eased back to this channel structure back in October of last year, we said this is a great opportunity to buy. Unless we close back below this channel, this is your opportunity to go long NVIDIA into next year, that which is 24, and here we are. And finally, I think some of your listeners will, and I apologize if I haven't been as verbally descriptive as I might be for those of you who are in a car right now listening. But this is the iShares 20-year Treasury bond ETF. This is an ETF, a single stock entity that's a high volume, very tradable ETF that is correlated with the 20-year Treasuries. It's basically a basket of 10, 20, and 30-year Treasury bond instruments. In other words, it is directly correlated with the interest rate environment. And like a Treasury bond, it is inversely correlated. So as the market has dropped from its 2020 high to its most recent October low of last year, that has been the rise of interest rates on a pretty consistent basis from the COVID low, as you might say, or the COVID high as far as the bond market is concerned. What I'm pointing out here is a 4-year descending channel top that is at 102.83. We came not far from testing it back in September. We got up to 101.64 and have since fallen away. And I can just show you here that there's another channel structure we recently settled below about a month ago, that this basically underscores the fact that the long-term interest rate market remains one of continuing to move higher. And I'm not saying that we're going to surpass the high mark that was put out in October of 23, although the risk is certainly there. Unless we can close above 102.83, and this level is dropping every week. Next week, for instance, at 102.48, so forth and so on. This is what I call a dynamic approach to trend identification, where you're following these line studies. And if we close above this formation at the end of a week, we are now out of the woods in terms of a higher interest rate risk, which is still pervading the longer term market. And I think that'll do it.
Yeah. Yeah. Again, for any listeners who are in their cars or just on their walks on Spotify or some of the other audio channels, that was really insightful. The channels themselves. Now, thank you for the visual, because I think I'm finally
Sure.
getting it. Is it your firm that's establishing those patterns, or is
It
that?
is.
It is. Okay, I thought so. I thought it was the obvious, but I'm pointing that out for the listeners
Yeah,
as well.
they're not dished out to us. That's the
Yeah.
there's an art and a science to this, and there's an experience of 30 or 40 years where you have to determine what are those price points, those lows and highs that you're using as the means by which you're constructing these formations. I go with the extremes usually, as you might have seen on those charts, and so those are the kind of the worst case ceilings and floors. Those are the ones that usually hold the best anyway. So yes, we are constructing those. We have decent software that's that's a cloud-based software I've been using for years. It was on the trading floor, commodity quote graphics, CQG. And it was on the trading floor. And when I left the trading floor, I got a subscription to it. It's pretty pricey, It's an industry software program, but it works beautifully. It saves me a lot of time.
And it's still around all these years later. So that's a testament
It
too,
still
isn't it?
is. Yeah, absolutely. Yeah.
So you mentioned millennials, your daughter, obviously in need. I mentioned my sister. Somebody who's listening to this and completely overwhelmed as I was just about the technical jargon of it. Do you find that a lot of people are trying to do their own trades as opposed to going with a broker?
I think, yes, I think there's a growing body of traders who are going it alone. There's a lot of free information on the internet. And, as with the internet, you must be careful of what you listen to and who you listen to. There's a lot of YouTube, um, you know, uh, I'll call them analysts. Um, one of my problems with it, and I've watched them once in a while, I check them out, that they don't have highly specific price points. And that's, I think, what the beauty is of the work that I've done in the commodities world for 30 plus years, and now in the stock market for going on 5, is the fact that we have precise price parameters, precise price points that the market needs to settle above. And it's not just push above on an intraday basis. Let's say that you've got a stock and it's trading at $50 a share. And let's say that, I've got a 2-year channel top that's coming down at, I don't know, 10 cents a week, and it's above the market at $52 a share. That is your price ceiling. If we close above that long-term channel top, it needs to be by at least a 1% margin, which would be, what, about a nickel or something, right? Or 50 cents. And that would be the parameters. We have them very ironed out. We mentioned them in our videos. So if we were to close above this channel structure, it needs to be by a 1% margin, because there are many times where a stock will trade and close above this price point, but not by a 1% margin. So if it's at 52 and your 1% threshold is 50 cents, and it closes at 52.3 rather than 52.5 or 52.6, which would be the 1%, it's a no-go. You have to wait it. You have to wait it out. Some people like to jump the gun, and I learned a long time ago it's not worth jumping the gun on what you perceive to be an impending buy signal when it hasn't actually materialized yet. So we really stress patience. Wait for the market, wait for the buy signal to unfold before you act. And then when that market unfolds, there's Ed Seykota is in Market Wizards. It's this great book from the 80s, and he made a fortune in the commodity markets. And he used this analogy: a tiger in the bush. A tiger will sit and wait for hours and they'll watch their prey for hours before acting for that exact right moment. Rather than bursting out of the bush early and not catching their prey, they'll wait for the right moment. And I use that analogy a lot in trading. You wait for the right moment to develop, and if it doesn't develop, you don't act. And when it does develop, you must act. It's about as simple as that.
So if somebody's brand new, completely wanted to get into this, what would the best piece of advice that you would offer them when they're starting out?
I would say take it slow. You've got a lot of time. I would say don't put all of your chips on don't invest everything in one stock. That is something that I see happens a lot. We've got the free NVIDIA and Tesla analysis that we offer on YouTube. And, I don't really read the messages very much. I have a problem with negative messages. They keep me up at night. So my son weeds through all the commentary. Most of it is actually very positive. But what we're oftentimes flabbergasted by is many of the gamblers coming into the market who are just trying to swing for the fences. And they're all in on this, what I would consider to be a relatively minor buy signal in NVIDIA. That is not a big picture buy signal, but maybe it's good for the next 3 to 5 days to the upside. And they are all in. The short term signals don't work as well as the long term signals, generally speaking. And so when we hear that they're down, they lost, much of their money, Our first question is, where's your risk management? Where's your stop loss? Never risk more than 2% of your trading capital on any given trade. So if you come in, with a $10,000 account, let's say, many of these millennials will only come in with $10,000. They shouldn't risk more than $200 on their investment. Many of them are risking $1,000. If you have a string of losing trades, and it is inevitable, the more you trade. And if you are willing to risk 5% of your trading capital on any given trade, which I think is too much, but if you are, all you need is 3 losing trades in a row and you're having a bad year. You're down 15%. So, keep the losses tight, 1 to 2%. Most of the trades that we have in wicked stocks is far under that envelope. We provide stop loss levels that are in the 1/10ths of 1%, which keeps you in the game. These line studies that I'm showing, where you have to close above it by 1% as a buy signal. Well, now you're in the trade. You're long the market. You own that stock. Maybe it's 10% of your trading portfolio. And if that stock trade does not work out and the market begins to fall away and then close below that line study by a 1% margin, we're out. And usually, if you've got less than 10%, 10% of your portfolio allocated for that 1% stop loss is going to be 1/10 of 1% of your trading capital, if you catch my drift. So,
Mm-hmm. No, it's really good advice. I mean, I started out this subset question of asking what was the best advice you would give, but I'm going to follow that up with what is the biggest mistake that you see new traders making?
I think it's not coming to the game with a thoughtful and pre-calibrated, pre-authored risk management approach. There are a lot of things to think about. How do I get into a trade? Do I get, how do I get out of a trade? What should be my stop loss strategy? What stocks am I going to invest in? Will I play the short side of the market? I don't recommend that for new traders. So you're looking for buy sides. Don't trade out of boredom. Don't trade because you saw some guy on CNBC. I mean, it's entirely up to you, but I wouldn't recommend just, deciding to put 50% of your portfolio in a particular stock because some fellow on CNBC recommended buying the stock. Yeah, I mean, if yeah, and I probably am going to get myself into trouble saying that because I am one of those guys sometimes, But if they don't say why, if they don't give a good rationale as to why, I'm really leery of it. And you see analysts on television and on radio a lot. Well, I like this and I like that, and we bought some of this, and but I need to see the rationale, and I think that's one of the beauties of the work that we do is we present the rationale, the very legitimate, setup for the buy signal based on these classic chart formations. Channels. One of the reasons I love channels is they've been used for hundreds of years. They've got. I read somewhere that they found the Chinese rice traders back 3,000 years ago. They've got channels that they were following for technical buy and sell signals. Yeah, yeah. So the channel structure goes back a long time, and I don't think it'll ever not work. Nothing's 100%. So that's another thing too. Is if you're a new trader and you're looking at it could be moving averages, it could be volume if you're a technical analyst, or maybe it's price earnings ratios or debt to equity ratios, or there's a million and one ways to analyze a market fundamentally or technically, and whatever you gravitate towards. Make sure you know it well and that you have a system, a rule based on when you're going to activate a trade based on whatever that method is presenting.
Yeah, as you're speaking, Cary, I mean it really speaks to educating, being transparent, which I think young people today, I mean, everybody, with the advent of the internet and how free information is flowing, I think everybody's becoming more and more aware and educated, and just following somebody that just because they have I don't know, a million subscribers and they say buy this pales in comparison to being able to get underneath the hood and really see why that person is making that recommendation. And I commend you guys for doing that.
Thank you. Yeah, we started out, our mission was really to provide directional clarity. And it had a special focus and still does to the new traders. But the funny thing is, because I've been doing this for so long, and my cadence and the way I speak is technical, that I would say at least half of our followers are more experienced traders because I'm speaking their language and they understand it and they appreciate it. And I think sometimes it sounds like I'm talking over the heads of the new trader, and I forget what it's like to be a new trader, understanding new terminology. No,
Present, yeah, present
right.
company included. Yeah.
But I think our videos, all of everything we dish out is by video, and that's for a reason. Because we get to show you what we're looking at and why it is that we think this is a good buy recommendation, or not so fast. It's not time to buy yet because we're now testing a price ceiling. And I will say, oh, by the way, for those of you more experienced traders who like to trade both sides of the market, and by that I mean both long and short, this price ceiling that we are now approaching is a good opportunity to sell the market and maybe go short. And that's where you get into options, where you can buy an out of the money put. And I'll give the expiration date that I would recommend, because this move is probably going to take 2 or 3 months to play out. You should probably go 6 months out on the expiration of that put. And what I mean by that is options have an end life and they decay over time. And so, in order to preserve the sort of punch that option can provide, you want to go further out in time. You don't want to go, if it's a 2 to 3 month move, you don't want to buy an out of the money put that will be expiring in 2 weeks. It just doesn't make any sense because it will expire worthless. Your investment will go up in smoke. So there's another deeper in the weeds element for you.
Oh, absolutely. As we wrap up here, I just wanted to spend a few more minutes, throw a little bit of a curveball at you. So, as deep background, my family had Chinese restaurant for 50 years in the family. They wanted me to take it over. There was always generational differences, and I think you know where I'm going here. And now I have two boys, 21 and 23 years old. Older one's following the path of his mother. He's going to be a nurse, and the younger one actually just signed up to join the military. The long story is, though, nobody wants to get into dad's business of real estate and property management. Speak to me about the dynamics. I mean, the joy, first of all, of having your kids working with you, but then the dynamics and what that looks like.
Well, that's a great question. So I've had to wear early on, especially, I was the one who knew everything, right? I mean, literally, I knew the markets, and my son, though, who's been doing this for 3 years, he's burned a lot of midnight oil, catching up with dad, and he's actually become a talented analyst in his own right. Um, but over this time, there's the whole wearing the boss hat versus the dad hat and getting them a little confused. I love working with my kids. In fact, my ulterior motive, which was unspoken, at least early on, was, oh, this is a great, I live thousands of miles away from them. They're in Colorado. I'm in Washington State at the time. And so this is a great opportunity for me just be involved and have them in my life. But it's been a great opportunity to, I've never really had a team around me. I've been kind of a one-man show. I mean, I outsource things in the commodity world and so forth, but for the most part, I've not had a team, a web team, an analytical team that my daughter and son now are. And we're looking at even expanding more into hiring others. But it's been an interesting process, having to learn to cooperate where I want to be the dictator and to tell them everything I
You
think
want
they
to be
should
the
be doing.
dad.
I want to be the dad. This is where the dad hat comes on.
Yeah.
And so sometimes after a conversation with them, and I'll ask myself, now would I have talked to an employee like that, or did I talk to them because they're my kids? So there's this whole process that I've had to go through, but it's actually worked out really well. My son loves the industry, and my daughter actually had, when she was in college, she interned for a nonprofit in Aspen, Colorado. And her whole job was really to kind of manage the WordPress website and the back end of how it connected with HubSpot and automated email funnels and so forth. And so she had an early lead on that, and that's what she really manages for Wicked Stocks now. My son does a lot of the video editing and the early analysis. He gets out ahead of me, and we'll have a Zoom call every couple of days where he'll say, okay, he'll show me 10 stocks that he's found that looked promising as a candidate for a stock pick video that we could do like that day or the next day. And we will walk through them together. And sometimes I'll nix them and sometimes I won't. But for the most part, I'm in total agreement with him now that this is a great candidate. Let's do it. He'll then create the 5 or 10 different charts that shows near, mid, and long-term structures. And then I'll just do the screen share video. And then we upload it to the website and send out the automated emails for all of our viewers to see it, firsthand.
Yeah, no, I think at our age, we tend to, again, having the dad hats on, but even more than that, because we're experts for so long in our industry, it's hard to listen to younger people who are, again, more maybe digitally, prowess than we are. What was
Totally.
the biggest aha moment that you had with your kids when it was like, okay, I've got to like really defer to them?
Well, that's a great point. My son, so not only does he do a lot of the analysis, but he's really into sort of the Twitter, posting posts on Twitter. So he also understood the power of YouTube. Before Travis came onto our team, he was the one who introduced the fact that we should be doing free analysis on YouTube as a means of highlighting our work and encouraging people to become subscribers to wickedstocks.com, where they could get so much more in addition to that. So, um, you know, they're tech savvy, they're internet savvy. They grew up with the internet. I mean, I remember my kids. When so you have to go back to 10 years or so. Travis is now 26. I think he got his first smartphone when he was 14, and his mom and I were, this is really a safety element. We want them to have the smartphone so that we
Sure.
can reach them at a moment's notice. Well, as it turns out, they grew up with the thing and they understand it like I never would. And so, when we work with web developers, we have a web development team that we've outsourced. We have, weekly Zoom calls with them with new things that we're looking at. My kids understand everything that these technicians are dishing out. And I'm the one who's like raising my hand and asking for further clarity. And my kids are like, Dad, we'll tell you later. Just keep,
You're slowing us down. Let's go.
you're slowing us down. Yeah. So it's pretty funny. But yeah, I mean, they're definitely a generation ahead of me with respect to the technology.
No, I think any business leaders that are on this, listening to this episode, can definitely take some advice there. I've certainly learned that. Listen to the people who are, going to lead your company someday. It can't all be with you, right?
Sure.
Definitely. Yeah.
Absolutely. Yeah, no, and that's the great thing about having my kids on board too. It wasn't planned, I never really groomed them. My son had a mathematics degree, and he was looking at going on for an engineering degree. And it was right in the middle of COVID. His sister and I had started Wicked Stocks a year earlier. He was very intrigued with the entire element of stock investing and trading and analysis, and he came on as just sort of a temporary, help. And it just mushroomed into, I think, will be his career, and is his career. He's been doing it for 3 years now. We're continuing to grow. My kids each have an appreciable share of the business as ownership. We're partners, literally. It's an LLC, and so it's a beautiful thing, really, to as a team to grow it. And to continue to prosper from it in an increasing way, and never losing sight of our mission statement, which is really to provide sort of an understandable approach to investing and trading in the stock market that might not be available anywhere else from on a very visual and mathematical level.
Yeah, I'm really big into goal setting, and what you're doing there is commendable, and really leaving a legacy, right? For yourself, but for your family and for your kids. It's amazing.
Absolutely. Yeah, very much so.
So, final question, when as we wrap up here, I ask every guest this question. So, my listeners want to know what Cary Artac has to say. So, this is the Investing to Win podcast. How do you define success, and what does winning look like for you?
Oh, very good question. Well, the winning is oftentimes represented as a bottom line, in terms of trading wins, trading percentages. What does my trading capital look like from a year ago to now? You can define winning that way, and I do. But for me, it's a more holistic answer, and it has everything to do with my state of of being, really, my level of joy that I experience in my life. Am I living a balanced life? That's really important, because I have spent time over the last 30 or 40 years where I'm disproportionately invested in, committed to my company's growth. And over time, that has its cost. So about 15, 20 years ago, I had sailed Lake Michigan back in the 80s with a friend who bought this beat up old sailboat, and we're in our 20s, out there, 2, 3 miles out in the waves and the wind, and having a 6 pack of beer, and that was beautiful. I loved it. And then I took it up again back in like 2010. And it was really it just was a means for me. I've got to balance my life with the things that I really enjoy. So I took a refresher course. I bought a decent sailboat, and I've been an avid sailor ever since. And a few years later, I bought a condo in Crested Butte, Colorado, where my daughter actually still lives to this day, as a means of skiing. And so I've broken up my day where I'll steal an hour or two in the morning where I could go ski fresh snow. Just sort of living the dream. I suppose I'm able to do that because I can work remotely. But I think the real takeaway for me, the lesson that I've had over the last 20 years, is to really mix your life with not only your work commitments, but your play commitments. And I can't tell you how many times I've been on a ski slope or out on the open water sailing quietly, and I'll have an epiphany about my work that just sort of bleeds into my thoughts, that I don't think would have otherwise emerged were it not for this sort of relaxed, sublime state that I was in. So I think it's really important to find other passions, beyond work, to balance that out.
No, I couldn't agree with you more. I think if I were to look at the last 15, 20 years, the best and biggest ideas, my aha moments, occur when I'm on vacation, because my mind is empty enough.
Right.
Yeah.
Yeah, absolutely.
Well, that's a great place to stop, Cary. Thank you so much. I'm going to be putting lots of information in the show notes so people know how to get a hold of you guys at wickedstocks.com.
Great.
And yeah, I'd like to thank you for spending some time with me this morning.
Thank you, Gary. It's been a real pleasure. I've enjoyed the conversation.
All right. Likewise. Take care.
Take care. Bye-bye.